there's some powerful deductions that people are just not taking. Deductions that really can be a complete game changer for your ability to keep your stacks and not hand them over to tax. Your CPA has actually been told by the IRS, don't tell your clients about these kinds of deductions. Hey, everybody, welcome to Stacks Over Tax, where we're going to do our best to try to help everybody make lots of stacks of cash and not give it over to the Uncle Sam at tax. I'm Mark Lewis, and I'm here with the lovely Sterling Grace. And tonight we're talking about deductions. Sterling, when you were first told what a deduction was, did you have any idea? And what did that mean to you?
I assumed anything that I wanted to, I could write off if I could reasonably account it to business. So, for me, that would include Chanel red lipstick, right? Probably would not include that for you, but for me, I certainly think that seems like a reasonable deduction.
Well, these days, who knows? Yeah.
That's true. That's true. But no, I certainly didn't know that the IRS had any guidelines or parameters around that. So when I was a young business owner, I'm sure I wrote off an enormous amount of things that were not appropriate. And so I can't wait to see what we're going to learn today about deductions I should have been taking that I'm sure I wasn't, and maybe some things I probably shouldn't have been taking.
Yeah. Well, it's funny to me, when I first learned about them, my dad taught me just about everything I needed to know for the first 20 years of doing business. I started at 16 with a little, I was a musician in those days. And he's like, well, here's how you fill out your taxes. And this is the Schedule C. And here's a deduction. And man, I didn't know anything. It made sense to me that, well, should I get taxed on things that I'm spending on a business? But I thought, well, the government's going to do what government's going to do. But yeah, the deduction. And then I love in The Office, there's these scenes with like functionally silly people where they're like, well, do you even understand what a deduction is? Yeah, it's where I buy something and the government pays me back.
It's a reimbursement program, right?
It's a reimbursement.
Expenses for corporations. You just write off the paper or whatever it is that you needed on the trip. So,
totally. Yeah. And then they hand you money back. Of course, that's what a deduction is. You deduct it. No, there are definitely taxes that we have to pay. No question about it, even in this voluntary tax system that we're in. And there's some powerful deductions that what we find, we see all the time that people are just not taking. Deductions that really can be a complete game changer for your ability to keep your stacks and not hand them over to tax. And some of those, many of them, in fact, that we're going to talk about tonight, your CPA has actually been told by the IRS, or you're an EA like me, you're an enrolled agent. We've all been told, don't tell your clients about these kinds of deductions. Not because they're not legal, not because they're not in the Internal Revenue Code, but we've been advised that anything that requires a great burden of proof from your client should not be told to them because it's so difficult. And I get that the IRS would have a lot to have to sift through if there was an audit, so better that those aren't taken. But it doesn't mean that you can't take them. And one of those that we're going to talk about, it has a ton of burden of proof, but just about everybody that that I say, hey, you can take this, they're like, wait, what? You don't even have to have a business to do that? Nope, not at all. So tonight we're going to talk about, I don't want to spill the beans, but we're going to talk about a couple of those. We're going to talk about the paying your kids tax-free, your children, how to pay them out of your company completely tax-free, so you get a write-off, and maybe what you can even do with some of that. We're going to talk about the Augusta Rule, which has so much misinformation around it. I mean, so does paying your kids tax-free. And then maybe why you would want to be married and file separately. And everybody's like, well, you would never want to do that. You want to marry filing jointly. And that's where you get all the deductions. Yeah. But like I said, as I always say, if it's free from the government, it's probably way too expensive to receive. So that's what married filing jointly is. And we're going to get into how married filing separately could be way more advantageous to you than married filing jointly. So
in the HSA.
Oh, we're going to talk about the HSA. That's right. The health savings account. What else are we? You've got. You're looking at the list. What else are we talking about tonight?
Sales tax and property
Yeah.
tax, and what is appropriate and what is inappropriate to take from
Yep.
that. So, yeah.
That sounds very, very good to me.
Sales tax is the number one thing that I educate people, random people, strangers out in public about why they have to keep their receipt for their bottle of water. So, yeah, because we just wad them up and throw them away. We actually need all those receipts. So,
Yeah. If you were ever in the sovereignty conversation, you know all that stuff where they talk about, oh, well, your receipt is actually the value. The actual things they give you aren't the value. Whatever that is, that's however you want to land on that subject. The real fact is, in the Internal Revenue Code is a sales tax deduction. You don't need a business. You don't need a sole proprietorship. You don't need anything like that. All you need is the ability to say, I kept a receipt. Now, it's hard. I don't know if you've heard this stat, Sterling, but apparently for the last couple of years, now somebody can come on and say, no, that's hogwash. It's this figure. But the aggregate data footprint of picture taking, like from your phone or your computer or whatever, on the planet, the aggregate, all of the data footprint of photos taken doubles every day.
that seems about right. As I know, especially for my pets, before my pets in the last 20 years, we've had 3 photographs of, and now I've got a picture of what they've had for breakfast and the new toy that they bought. And like, there's 1,001 pictures of my pets on my phone. So,
I've got pictures of Cheryl's pets, for goodness sake. I mean, I'm taking pictures of them. They're not even my own pets. So yeah, I got pictures and pictures and pictures of my chickens when I had them. I got hundreds of pictures of my chicken. And I don't know that a day goes by when I don't take some kind of picture. Well, it used to be that receipts, you only really need them for 3 or 4 years if you're a social slave like we are, not business. You need them for longer. But because, the IRS can only assess you up to 3 years back. After that, generally you're scot-free. I mean, unless you commit fraud, don't do that. But how do we keep all of these receipts? Imagine if you had to keep receipts for every transaction. That's a lot. I know by the time I do my data entry, it's like thousands and thousands of interactions with commerce every year. Well, you could take a picture with your phone, and that's perfectly legitimate. I don't know if you ever look back on your taxes from a few years ago and you're trying to find a receipt and you're like, I can't even read that. It's all the ink's worn off and all this. Have you ever done that?
all the time. Yeah, that's it. That ink now only seems like it lasts about 60 days. I kind of think they're in cahoots with the retailers that don't want to do returns after 60 days. So
yes.
That just disappears.
I can't even read your receipt. I don't know. Where was it from? I don't know.
That's what it was.
We have all these wars for oil, and it's like, guys, the most expensive thing on the planet is ink toner.
Yes.
That's what we should be going to war over. Forget the Ukraine and Russia. Hey, what about what's going on in China and wherever I don't know, where do they make ink toner? Maybe it's China, Mexico. We should be warring with those people. Make the price of that go down.
Unless you buy everything at Costco, and Costco just has an unlimited return policy, I think. So that's kind of fun. Yeah.
That's true.
Mm-hmm.
Costco's pretty cool. I don't live anywhere near a Costco. Somebody said, "Oh, Costco's got a sale. You should go see." I'm like, "Yeah, that's 2.5 hours from me. Sorry."
Maybe they'll ship it to you. I don't know. I've never tried that.
Well, yeah, they will. But I guess I gotta go see it. I gotta go see it.
Yes.
Yeah. Well, you live in LA, so you can get same day shipping from Amazon.
I got shipping. Yeah, I got shipping from 4 hours ago. I ordered something that I needed today, so we don't run out anymore. Now that COVID has happened, there's no run into the grocery store. The people just bring you the things. It's lovely. You have so much more time on your hands. So, and especially living in LA, where you're going to drive, pay to park, and wait and wait through all the human beings that there are to wait through. Like, it's really not that good of a deal when it comes down to your actual time and what I can get accomplished in a work day versus running an errand. So it's just not really worth it anymore.
It's true. It's true. Root Farm says you can save them in photo form. Yeah, just save them in a photo. Put them in a folder in your phone that says these are receipts. And then, you take a picture. It does kind of get messy because if you're using the iPhone for like recent photos, and you got all these weird receipts because you can't really get them out of the recent photo. Like, I love how it organizes my photos in the recent folder. But outside of that, but so you got to move them over to a folder. But once it's there, at the end of the year, you can then just send them all out, like airdrop them to your computer, and then put them into a folder, compress them so they don't take up a lot of space, or put them on a little backup drive with your taxes. That's it. And then 201B Money says you can buy a receipt scanner. Well, yes, that's also true. All of this is true.
But then you got to spend your Saturday night scanning your receipts, which just doesn't sound terribly fun. So, I mean, I guess it depends on where you live. So
that's true. That's true. Let's see. There are a few. Go ahead. What?
There's these new apps that you can take pictures and then they'll give you some sort of reward. I just don't really love that they're keeping up with everything I'm purchasing. That kind of weirds me out a little bit, but I'm the same person that doesn't use the Alexa and all the voice. I just go turn my lights off. It just works for me. Of course, I have a really old house. I have a 120-year-old house. So my house is not really wired up for all that stuff anyway. But very fun. Well, let's see. So if we're going to do deductions, the one big thing that we should tell people is that we primarily work with business owners, but this is one of those topics where it's good if you have a W-2 job. It's good if you have a business. It's good if you're retired. Like this is good all the way around. So
it is
a little bit different than some of the things we normally do with our time. So.
Yeah. And this deduction, and a lot of people are like, well, where does it go on my 1040? It actually goes on your Schedule A. And you're like, well, wait a minute. Schedule A is itemizing. Yes, it is. Itemizing is critical. PO1 says, I don't have a microphone either. Yeah. Alexa, that's like, first of all, I live out in the sticks. I live in the sticks in an 8,000 person town where like I can drive for at least 100 feet and not get a new Wi-Fi signal from somebody else. It's great. Like when I stay at Cheryl's house in Valley Village, Southern California, I can pull up my Wi-Fi and it's got like 80 other Wi-Fis. And there's a cell phone tower like 100 feet away. I'm like, this is bad. I can feel it buzzing in my body. So having another device beaming me in my house, and not to mention that, yes, they're listening, y'all. We know they are. They're listening. Yes.
Hopefully they're hearing something interesting and thinking, maybe I'll go on to another house. These people seem slightly too interesting for me. So
that's right.
Well, very fun. Well, let's see. So we're going to tackle this. So I vote that we do sales tax first because I think it's the one that's the most surprising to people. I know it's the one I definitely spend a lot of time educating just my random friends about, right? Of like, why is it when I go buy a bottle of water at 7-Eleven, Sterling now wants me to save the receipt? I'm becoming quite the pain for everybody in my life about keeping their receipts, but I'm trying to make them some money. So let's do that one first because that one is interesting.
Yes. And let's not forget about the receipt photography thing, because when we get to HSA, I'm going to blow y'all's minds about something that you may not have thought about for your health savings account and why you've got to keep your receipts, not for 3 years, but maybe for 30 years. Ooh. We're going to cover that. But sales tax deduction, there's a bunch of cool deductions that we really don't talk about because it requires a lot of receipts and a lot of proof that are on the itemized side. And if you don't know, there's a standard deduction that everybody gets here in 2025 it's a cool $15,000 per person. So, if for keeping the flesh alive, for keeping yourself alive, the IRS goes, well, okay, we'll give you $15,000 off. Nice. If you're married filing jointly, that's 2 of y'all, it's 30. No big deal. Easy math. But if you thought, that standard deduction is awfully kind, thanks so much for our voluntary tax, but I think I have more deductions than that. And this is not business. This is just you, the social slave, as we like to say. Then you can itemize. And there's a bunch of things on that Schedule A that has itemized items from the redundancy department, that has things that could potentially exceed $15,000. And one of those is the sales tax deduction. Now, you cannot do more than $10,000 in sales tax deduction. And a little bit bad news, it's combined with some other deductions like local taxes, like your property tax, or if you have other state or county taxes. All of those combined with your sales tax cannot be more than $10,000. but that's still 10 grand. And in a minute, I'm going to show you why you really, really want to do this. And some of y'all in tax season right now and are just handing it over to your CPA or to your accountant. Look, they're not going to do these numbers for you. They don't even return your phone calls during tax season. If you have tried to call your CPA during tax season and they don't return your phone calls, put a 7 in the chat, just so I know who my mates are in this, right? They don't return your call. So for us, we need to do the work. What's the work? Just do a little math. It doesn't take much. So we put the sales tax deduction in and we go, okay, well, maybe I do have $20,000 in sales tax. That'd be a lot. You'd have had to, in my state, I see it. I see you, B-Money. I see you, Read Form. I see you, Sherry. Yeah. Bad news. Sorry. So we've got, let's say, $20,000 in sales tax. You can't take more than 10. And then if you say, oh, I got $1,100 a year in property tax, well, then you can only take $8,900 of the property tax. All of them together can't equal more than 10. And if you say, well, yeah, but the standard deduction is better. Voicemail is not even set up. There we go. Yeah, even my favorite kinds of accountants. Yes. So, like if I have to have a $15,000 standard deduction, how does $10,000 help? Well, because that's not your only itemized deduction. Let's talk about the interest on your mortgage. Now, this one you've probably heard about. Your CPA's probably told you about it because it doesn't require very much burden of proof. All you need is the 1099 from the bank going, you've paid this amount of interest, and that goes and is reported to the IRS. That's easy. The rules on taking the interest on your home is that the loan amount cannot be more than $750,000. So that the loan's $1 million, that's okay. You can only deduct 3/4 of it. 750 is your cap, at least this year. So if it's below that, like some of you have, then all of the interest on the mortgage on your home, deductible. Now I know on my house, my last house where I had it was about a $400,000 mortgage. The interest I was paying in those first 2-3 years, it's always pushed it to the front, the max on the amortization. Yeah, I was doing, I don't know, $25,000 a year. You think about that. So actually it wasn't 25. It was like I had a really great loan. It was probably 15,000. Okay. 15,000 a year. Now, if I were single, that would be enough to have me go, I got the interest rate on my house and I got $10,000 in sales tax. I'm at $25,000 in itemized deductions, y'all. I'm way above the $15,000 standard deduction. Way above. Let's do that. And you can, but it gets better. Because then you also, for all y'all playing the lottery, or y'all going to whatever place you're gambling, your gambling losses are also deductible. Now, Sterling, do you remember the rules for gambling losses? There's only really one rule.
I save all my tickets now because I'm destined to win. It's just a matter of time. So
yes.
So I think I can take up to the amount that I win. So if I don't have to save the ticket if it was $2, if I spent $2, right? So, but yeah, I think that's the rule.
You got it. You can't deduct more than you win. So if you lost $10,000 playing the lottery and you won $2,000, you can only deduct $2,000. But if I did, now I'm at $17,000 overall.
What do you do, Mark, when you go play the slots and you put, your 75 cents of quarters in? How do you keep up with that information?
That's a very difficult thing to do. It's why I don't suggest you play we call them the one-armed bandits, because it's very difficult for you to justify. Now, what you can do is go to the cashier, and then you go to the cashier and put your money in, and you get chips, and you say, I want, or whatever that thing they put on the card is, I'd like a receipt for what I put in. And then you say, and then I want a receipt for what I was able to cash out or what I couldn't. They'll give you receipts. But there's some limits there. It's very difficult. It's not really the most effective tax way to gamble because it's difficult to prove. So then you have, on top of that, charitable donations. Now, on the charitable donation, you can put in, don't go crazy. You can't spend all of your money and give it to your church. You can't be like John the Baptist and just give everything away and eat locusts and live in sackcloth in the desert. Some of your money, there's limits. But if you tithed 10% and had $100,000, that's another $10,000 that you get to deduct off your itemized deductions. And let me be clear about this too. A lot of people are like, oh, I give money to my church or the American Red Cross or whatever that is, and I get a write-off. No, you don't. Not right away. Because if you're married filing jointly, what's your standard deduction? Not $15,000, $30,000, both y'all put together. And if you donate to your church $25,000, and that's all you know to take, and that's all your CPA did the calculations because they're not going to do the math for you, that's not enough to take the itemized deductions. Your standard deduction actually more. So you lost that deduction, technically speaking. So unless you're willing to donate more than, if you're married filing jointly, $30,000, and you don't know to take the sales tax deduction, the local tax deduction, the interest on your home deduction, you're going to lose some of those deductions. Y'all got to donate some more or something. I don't know.
So what happens when I go and donate, random household goods to the local Salvation Army or the Goodwill? Like, is there a dollar amount that I need to get the receipt, or do I always need to get the receipt?
Well, I mean, it's always good to get the receipt, but they're not required to give you a receipt over cash stuff over $250. And if it's over $5,000, then you actually have to get a third-party assessor to find out what that value really is, and then they have to give you a receipt. But if it's over $250, that's when the receipts need to show up. But beneath that, not really, no.
Oh, that's good to know, especially if people donate like cars, because now that's a big new thing that happens now, is that you can salvage old cars that you don't necessarily need anymore for charities. So,
yeah.
Well, I've heard that I was thinking about the property tax thing, and I've heard that I can rent my house out, because I was watching Instagram the other day, and they were talking about the fact that I could rent my house out and then I could have that be deductible. And so I'm kind of wondering how the Augusta Rule works. And is that a real thing, or is that like just nonsense on Instagram?
Yeah, we're going to definitely get to the Augusta Rule, but there's one other part of itemizing that we want to cover. And while we're here, let's see. Rondi says, instead of donating to my church personally, can I donate via my LLC and take the deduction? Of course, the rules are the same and when we say LLC, there's a bunch of different versions of LLCs. So it's either an S corp, or it's a sole proprietor if it's a single member, or it's multi-member, it's a partnership. Any of those, long and short of it, pass the charitable nature of that down to its members. So if you're in a multi-member LLC partnership, let's say there's 3 of you, and you have $1,000 worth of stuff that you're going to donate to your church, and you do it through your LLC, that means that you've done a capital contribution into the LLC, giving you basis. Okay. Now the LLC donates to the church, and when tax time comes, then your donation comes to you, but now pro rata to your shareholdership in the LLC, in the partnership, which means that instead of getting the $1,000 that you would have gotten in deductions, itemized deductions from Charitable, that you had done personally, now it's split up between the members, and you only got a $333 deduction because the other 2 Bahanyaks got the other thirds. So yes, absolutely. The only place, well, I shouldn't say only, but for the most part, the only place where those charitable donations do not just pass through to you in the C corporation, because nothing passes through to the shareholders, and the C corp gets some really cool benefits out of doing that as well. It can donate, it can write off every dollar, every penny it donates to charity, up to 10% of its income. It doesn't have any limits like we have with standard deductions. And then let's see, Root Form says, so if it's over during the year versus at one. So if it's over during the year, I'm not sure what that means. Help me understand what that means.
She donates, let's say she donates $10,000 to her church versus donating $100 a week. Is there any difference?
Oh, I see. Yeah. So that's a great question. So what if the limit's $250 and to get a receipt, and you just donate $10 for 12 months, or let's say $100 in 12 months. Now it's $1,200. If I never got a receipt, am I still good? And the answer is yes, because it was over a bunch of time. And hey, if you drove to the church to donate, that's also donation miles, charitable mileage. It's not a very good mileage rate, but you can definitely take it. And I have never, ever seen anyone audited because they took charitable mileage. Now, charitable mileage, I mean, unless you're driving to like do relief in South Africa, Johannesburg or something, it's going to be very, very small. And the mistake that people make is they go, well, I go to church, and every time I go to church, I take the I take the mileage deduction. No. You only get to deduct the mileage when you put something in the offering plate. Then you're like, well, wait a minute. You mean all those times I go to church and I have to suffer through the hour-long speech? I can't donate those miles? Not unless you put something in the plate or handed a check or whatever. So what you do is, if you're really miserly, if you're Dutch, I'm a quarter Dutch, so I get to make fun of us. If you're Dutch like me, if you're not Dutch, it ain't much. So you're going to go into the gutter, you're going to find a penny. And you're going, my penny now, possessory lien, I got a penny. I go to the church and I drop it in. Deductible. Mileage.
Well, this is good news because we just started Lent, the season of Lent yesterday.
That's right. What are you giving up? You know what I'm giving up?
What are you giving up?
As of yesterday, what am I giving up?
Gossiping.
Mm-hmm. 30-day gossip fast. We just did a 30-day complaint fast, which was quite difficult indeed.
Yes. You will notice that you complain all day long, whether it is out loud or in your own head. That was the most shocking thing, was how much I complained in my own head that isn't actually out loud. So,
dude, it's so insidious.
Yeah. But the great thing about giving it up is there was nothing else to do besides take action. You get more done in 30 days. Because there's nothing else to do. You just had to go do something. You couldn't complain. So you had leftover energy. So you had to work it out and figure out something to do about it. So
yeah. And she couldn't complain to me because I'm like, I can't.
I don't know how this gossip thing is going to work. This is going to be very fun. I'm excited about this.
It's going to be good. Yeah. I've done it in the past. It's really quite difficult. It's easier to spot than complaining, but it's harder to stop doing, because you're like, oh my God, have you seen Johnson? He's got a limp. What happened to him? Oh my God, it looks so stupid. No, it's gossip.
Especially when you live in a community of human beings who all know each other and love each other and are excited about things, it's very easy to gossip about all sorts of stuff. Happy news, bad news, sad news, crazy news. It's going to be very fun to see what we get to talk about for the next 30 days.
I live in a small town. It's not the paper mill that runs this town. It's gossip.
That's true.
It's gossip. All right. One other thing about the itemized deduction before we get really derailed here. So we talked about charitable, obviously. We talked about the SALT deductions, which are sales tax, local taxes, et cetera. We talked about the interest on your home deduction. We talked about gambling. But the one thing we haven't talked about is medical. And we're going to cover HSAs at the end, which we do really want to hear, because I learned something in the last 3 months that I didn't know about HSAs, which are completely changed how I use them. Medical, you can take your medical expenses as long as the medical expense is greater than 7.5% of your adjusted gross income. So if toward the end of your 1040 there, where it says this is your AGI, if that number, I'm making it up, let's say it's $100,000, and you have $10,000 in medical expenses, that's 7.5% would be $7,500. So you'd have $2,500 that you could deduct. Again, you had $100,000 in overall AGI. You had $10,000 in medical expenses. The threshold was $7,500, the 7.5%. And so this amount, the $2,500 is deductible. Now it can go on and up to $50,000 if you want. All of that's deductible. Some people are, have heart attacks, and some people have, the insurance didn't pay or whatever, or you just got, even chiropractic bills. If you can justify the medical expense as medical and truly necessary, that's great. So one of the people in my enrolled agent training, her mom, let's see if I get this right. It doesn't really matter, but somebody put in a wheelchair ramp and wheelchair bars on their house, which was super cool. And that they made as a medical expense, which was because her mom had to be in a wheelchair. And so they were able to write that off that year. But the problem is they couldn't deduct it in any other way, because what they actually did was improve the value of the house, which is a capital capital expenditure for the house, which is supposed to go against basis. So they ran into a bunch of problem with that. So be careful if you're like, some people put an elevator in their house, $300,000, $400,000, $500,000 elevator to help with the thing. Cause they've got Sterling's worked on some pretty large houses in Hollywood and there's an elevator in there. Well, can you write that off if it's for medical? Well, I would definitely consult with somebody because the issues to your house are also strong and need to be considered. But if you could,
Mark, does it matter if the person is more of a practitioner of Western medicine versus Eastern? So, for instance, like if I go to my doctor versus I go to my acupuncturist, because here in LA we all have an acupuncturist. So, as long as it is generally considered a medical need, is there any other criteria that the IRS has any commentary about?
I mean, if it's medically necessary, it's medically necessary. And if one of our favorite sayings that we talk to our members about is if you can defend it, you can keep it. And that's one of those gray areas. And fortunately, it's gray. There's a lot of gray areas. We haven't talked much about business deductions yet, but there's a lot of gray areas where the IRS is like, if it's reasonable, ordinary, you can keep it. But be able to prove that. This week, all week, we've had a big discussion in the membership about, how come we can't write off first class flights? How come we can only write off economy flights? We can't write off first class flights. And how do we do that? What are ways that we could legitimately, not trying to avoid, not tax evasion, not trying to commit fraud, but what are defendable ways in which we could actually write off upgrades to flights or vacations, so-called vacations for business purposes? What does that look like? And that's a very, we should do a podcast just on that. Yeah, because that's a very interesting subject. We're belaboring this sales tax deduction, but I want to give you if we added $10,000 sales tax, we added $2,000 for gambling debts. We added, what did I say? It was $10,000 or $15,000 for interest on your loan for the year. What are we at now? $27,000. And then we added another $2,500 for the medical. And then you did, I'm making it up, $10,000 in charitable donations. You're now at $37,000+ in deductions. And even if you're married filing jointly, your standard deduction is 30. Now you're at 37. And if you're in let's say you're even in a 20% tax bracket, which is pretty hard to do if you're doing those kinds of deductions. Let's say you're in a 30% tax bracket. You just saved yourself $2,100. Wow. There's never a point in all y'all's life where $2,100 means nothing to you. Not anymore.
For sure. No.
So I just saved y'all $2,100. Aren't you glad? If this is interesting to you, put 3 in the chat box. Put a 3 in the chat box if this is interesting. All right. Now, you wanted to talk about Augusta Rule.
Augusta, because I've heard watching on Instagram that I can just rent out my house for like 2 weeks and make a ton of money and take it off my taxes. And, I don't really know if that's true or not. So
it is. I've always heard of it as the Augusta Rule. The Augusta Rule. It's because the rich guys got together and in Augusta, Georgia, during the big golf tournament there for 2 weeks, and they worked it out so that they can rent out their homes for 2 weeks while they're away because they don't want to be there from all the crowds, and then they get to make money tax free. Well, I don't know about all that. I mean, if I had a $10 million house in Augusta, Georgia, I would not want it to rent out my house. I would just leave and not rent it out to fools who I don't know who you are in my $10 million house. Maybe. Nonetheless, that rule has been in there for a while. And when we learned about it, they obviously went over it in our training and said, oh, here's what it is. They don't call it the Augusta Rule. It's basically, the rule is it's in 280A, and you can look at the whole section, and it's really kind of found in Part G, but it's the whole section. It also covers some other cool things. I honestly strongly recommend. Oh, I see. Thanks for all the 3s, everybody. I honestly recommend you look at that Internal Revenue Code. Just literally, if you don't know how to find it in Cornell Law, Title 26, Section 280A, then just type it in ChatGPT and go, can you just show me this? And it'll print it out. It's very readable, very plain Englishy. Basically says your residence. Now that includes your second home. It includes it if it were a boat, not if it's an aircraft, but if it were a boat, you're good. Summer home, cabin, log, maybe not a tent, but something substantial. If you're not renting it out for professional use, like you don't have a house in the back that you're renting, that would kill your Augusta Rule possibility. You're not Verbo, you're not Airbnb, you're not doing any of that. It's just your humble abode. Maybe not so humble, but your abode. And you're not, why not a plane? Because a plane is not a domicile, according to the IRS. You cannot live technically in a plane because a plane is a mobile vehicle. Same way you couldn't make your RV part of your Augusta Rule. That's never going to work. It's meant to move. And you're like, well, what about my mobile home? That doesn't move. Well, I know, but mobile homes are different. There's different rules there. I mean, unless you are moving it around, then no, it's never going to work. So that's expensive, by the way. So it has to be your abode, your home, where you really live, and you cannot make it your business hub. So you cannot get the business use of your home, which we're going to talk about if we have time. Wow, time's going fast. With the business use of your home, no bueno, and Augusta Rule. So one or the other. And that's a big bummer for some people. I know it's been for me until I figured out the solution. So those are your two big caveats. As the homeowner, can you do this with your rent? Sure you can, if it's your abode. And your lease allows you to sublet, which the IRS doesn't care about that, but you figure that out with your landlord. You can rent your house up to 15 days. Now, people get this wrong. Oh, it's 14 days. No, it's 15 days. Which is 14 nights. That's where the 2 weeks come from. They don't have to be consecutive. They could be any time, one here, one there, the other. It doesn't matter. Or they could be consecutive. Doesn't matter. You have to have a real contract, real rental agreement. There has to be real money that goes back and forth. And y'all think that, oh, well, I'll just hang out and stay in the room and I'll just rent out the other place. No, guys, if you stay there when, oh, hey, Brian. Oh, that's Byron. Brian. Oh, Brian, your name is so small here. Welcome. Another fellow enrolled agent. So if you stay in your home during a rental, that's not a rental. That's a sleepover. That's not deductible, y'all. You can't deduct a sleepover. So you're going to have to leave. You're going to have to go in the RV is fine. Just not, in your place. Go to their place. Well, who knows? So that's your rule. And you have to receive money. Now, here's where CPAs get it so very wrong. You guys don't listen to me, the bald guy, and maybe listen to Sterling, but you don't have to listen to me. Go read the code for yourself. And you tell me anywhere in there, does it say that this income must be reported? Now, look, the IRS, they are so strict about reporting your income. They're very loose about deductions, and we talked about why. But when it comes to reporting your income, you have to report all of your domestically earned income, living domestically, working domestically, or income that you made overseas living domestically, or income you made here living overseas. That's the three big rules. And you're like, there's a lot of loopholes there. I know. But if you don't report that stuff, they're going to come and eat your dog. They're going to come nuke your dog and eat your lunch.
Oh, no.
I know. It's really bad. Don't do that. But in 280A, it says, do not report. It doesn't say it that way, but it basically says no Schedule E for you guys. We do not put Augusta Rule income on Schedule E. If you do, theoretically, you could fall prey to what's called the 6702 violation, which is the frivolous filing. You're wasting IRS resources and filing things and putting things on documents that are unnecessary, unwanted, and actually, again, that's bad. That's a $5,000 penalty. I've gotten them. They're not good. So we don't want to play that game. And that's why CPAs, rightly so, are like, I don't want to do the Augusta Rule. It's way too much. Yeah, of course. Because if you do that, not only are you going to possibly get audited, you're going to get a big slap fine. And if you're a CPA with a firm or an EA with a firm or whatever you've got, everybody gets audited. That's bad. and the fines are significant. So don't report it. Now, where it gets interesting for people, and Sterling and I talk about this a lot, like, well, who would rent my home then? I don't want some Yahoo schmo coming into my home for 2 weeks or a bunch of weeks at a time. Well, couldn't I have my company that has maybe my family in it or friends or cohorts or whatever I like? Can't they come rent my house? And can't they do business activities, have a symposium, have annual meetings as required? We can have salespeople in. We can do all kinds of things because maybe I have a nice home or maybe I don't, whatever. I can rent it out to them. Can't the company then pay to be there? Yes. But, and then the company rules for deductions all apply. And this isn't, everybody's like, oh, special rules for companies in Augusta Rule. No. It's the same old rules as if you'd gone and rented a hotel. There has to be a real agreement. You have to have real money. There has to be a real business purpose. I mean, a significant business purpose. And again, that's very gray. You're going to have proof of the significance, proof of the benefit. And those are the big ones. And just like a regular old deduction, we've got people who have guests come in via Zoom and like teach a class. So then they record the Zoom. So they've got evidence, Look, the IRS knows you're human beings. You need to have fun. You need to sleep. You need to eat and all that other stuff. They get that. But the primary purpose being for business could be really good, especially if you've put in your operating agreement that you have to meet at Johnson's house because he's got the special safe with the documents or whatever that you have to review. Part of the operating agreement makes it even more intense that you've got legitimacy to do it. But some of you are already like, there's a huge problem. Huge. For the company to get the deduction, what does it have to, what's the one thing that I haven't said that they must do? What is every company? If I pay Sterling for a service for me and it's more than $600, what do I have to send to the IRS in order to be able to legitimize that deduction?
A 1099.
Boom. 1099, in this case, an MISC. And once the company files that, sure, it's going to give you the cash and you don't have to report it. Yep, Root's got it, 1099. You don't have to report it. That's great. And it's going to get reported to the IRS. It's going to get reported by the company. Otherwise, they can't deduct it. And if you've set up a C Corp LLC combination like we do with our clients, that's 21%. You just got you got to take it. And now it's getting reported and you don't put it anywhere on your form. And an IRS agent is going to look at this and go, there's a 1099 over there that says you didn't report. Remember what I said? Reporting is critical. You've got to report. They're going to go, big problems. Again, another reason why CPAs go crazy over the Augusta Rule because they get audited. They're like, what? Why wasn't that reported? And the company can't not send a 1099. It's required. I mean, if it's going to take the deduction, why would it do it otherwise? So how do we solve this? How do we make sure that the IRS knows what it is we're doing, which code 280A that we're invoking?
I don't know, but I do know they love to be communicated with.
They do.
They do.
Mostly.
That's a big mistake that most people make mostly is they're just afraid. They don't want to talk to them and they certainly don't want to read the letters they get from them. So communication's everything.
We're going to have to do a whole course, a whole podcast on how to respond to the IRS.
Yeah.
I'm seeing all these things that we need to do. I hope you're writing these down because I'm not.
I got a list.
I got a list. Sterling's the organized one. She's also the good looking one, just in case you hadn't figured that part out.
Yes. Thank you.
So the
solutions
is usually not available to your CPA because they file electronically. And if you file electronically, it's very, very difficult to do this solution. Send them a letter. Now, if you file electronically, yes, you send the stuff in, they're still going to flag it. It's still going to be, hey, there's $10, $20, $30, $40, $50,000 missing on income here. They got reported from this company. Where is it? If you send a letter to them, that's going to go to a different department. Someone else is going to see it. They're still going to generate a problem letter to you. At the very least, maybe an audit summons. And then there's going to be this weird lag. And if you've ever worked with the IRS, you know that one department has no idea what the other department's doing. Even with their new AI upgrades, it's still like, wait, we don't know, huh? What? You ever tried to call the IRS? By the way, don't call the IRS. If you ever tried to call the IRS, yeah, Sherry, you got it. You ever tried to call the IRS and they're like, well, I sent this in to you 6 months ago. We don't know, but yeah, okay. So write the letter. And if you can, there's new rules around filing on paper now. If you have more than 10 information, or if you have more than 9 information returns, you can't. You have to do electronically. But if you don't, you can send the letter in with your 1040 saying, hi, this is me, the taxpayer. I'm invoking 280A for $25,000 that I received from that use of that code, the so-called Augusta Rule. I haven't reported it because under that code, my understanding as a sovereign citizen of the United States is that I don't have to report it. I've done so. If I'm incorrect around this, please guide me into reporting this. I'm not trying to avoid taxes. I definitely know that a 1099 was filed on my behalf from XYZ company, and you probably have that, but note that my understanding of 280A is that I don't have to report it. If I do, let me know. Thank you so much for your service to the great citizens of the United States. Goodbye. That's a letter. Please don't use those words. Use your own. But that's what you would do. And now they have total understanding of how this works, and they're good for the most part. I've never seen anyone do Augusta, send the letter, and have any problems.
Wow. That's amazing. I love it.
Yeah, letters are cool.
Letters are cool. The other thing that I always see tons and tons and tons and tons of posts about is that I could, well, my daughter is grown now, but I could have paid my kiddo tax-free while she was a kiddo. And I'm kind of like thinking, I wonder how that's going to exactly work, because she would have had to have some kind of job, right? Like, yeah. And so, how does that
my son's 30 now. He's about to turn 31. And when we do chats, and some of you haven't been with us long, we have rules of the chats. We have, if you understand, like I'll say, do you understand what I'm saying? And then you would put a 1 in the chat, just so I know you're all not zombies. So if you understand, if you're with me so far, put a 1 in the chat. And then if you're having your mind blown, like, wow, amazing, you put an exclamation point in the chat. If you're confused, like, oh, I don't understand, put a 0 in the chat and then what you're confused about. And then if you're mad, you put an 8. I love my haters, but I really love my aiders. That means you're mad. That means you're present. Oh, I don't see any 1s. Everybody's a zombie. Okay, it's just you and I, Sterling, today.
Oh, good. Okay.
Yeah, the zombies. My brains. No, just you and I. So I put 8 in the chat box of the pay your kids tax-free conversation because I got a 30-year-old and not 1 year did I ever pay him W-2. And I've always had some kind of company structure. Since I was 20, I shouldn't say always, but 20 on. So I'm like, doggone, how much money could I have saved?
Yeah, I know. I'm in the same boat. I think the summer my daughter was going to go to high school, she worked for me all that summer, and I just paid her cash. And then, we used it to buy all of her like back to school fabulous clothes, like, something spectacular. So,
like I know how much money my dad paid my brother and I on allowance. Like he could have written it off. This is back in the 70s and the 80s. I mean, I know like $5 a week ain't much, but hey, man, that's $60 a year and $80.
What if kids get allowance anymore?
I don't know.
That's an interesting question. I don't know how that works nowadays. So
seriously,
you do stuff for your allowance. I had to do things for my allowance. It wasn't like free money. Like,
that's not allowance then.
No, that's allowance. You work.
No, that allowance is we give you some things. And then you go buy candy or whatever kids do. Like I save mine up. What you're talking about, my parents did to me too. That's not allowance. That's the good stewardship of financial whatever.
All right. Very well then. So that's the difference. Well, you grew up in the city and I grew up in the country. So maybe there's a difference.
Yeah,
right?
that's true.
Yeah, there was hunting dogs to feed. There was stuff to haul out of a car shop. There was oil wells to check. Like Texas is a full contact sport when you're a kid. There was no sitting around after supper and just playing video games and eating candy. There's a lot of things to do. There's gardens and chickens and so many things. So,
Oh,
but city boys, what did you city boys do after supper? You just watch TV?
well,
Watch
I tell you what.
PI? What'd you do after supper?
No, Mom watched Magnum PI. No, no. Yeah. So no, I did a lot of piano practice, and then by the time I was 10, I had a TRS-80 MC10 computer.
Wow.
It had 5K of memory. 5K, not megabytes, kilobytes, man. And it had a little membrane keyboard, but by God, I learned how to program in BASIC. And I could make little games, and that's what I did. I was a super nerd. Yeah.
Well, that's right.
Yeah.
That's actually been very beneficial for business. So
That's right.
But I would say that there's the other good benefit of being a Texan is, we have a saying of no one ever drowned in sweat. So we're definitely hardworking, right? And find solutions no matter what the problem is. So there's no problems. There's just something I hadn't figured out yet. So
there's only solutions. Yeah. And we talk about this. We actually have a product that actually has the BOI tacked to it. And we just talked about the BOI yesterday. It's the BOI tax trifecta, and it's called tax trifecta, and it's BOI, Augusta Rule, and then how to pay your kids tax free. And that's a product. And just in case you didn't know, we have, I don't know, where are we at? 90 hours of products. And there's a bunch of ways I want to talk about the tax-free kids, but there's a bunch of ways that you can interact with us and connect with us. And I just want to play a little 30-second thing to kind of give you an idea of what we offer at Executive Money Strategies. Check this out. Yes, no babies were harmed in that. It was just
no, nor was any cigars smoked. I'd like to point out. So
well, that's right.
Lately, so
I might go smoke a cigar after this. I've got some nice ones. Cheryl gave me a whole pack for Christmas of like a tester, and so I've been going through and making notes on which ones I like.
Very fun. I love it.
I know. That's transformation for you. Imagine me smoking a cigar 5 years ago.
So many things, Mr. Lewis, in the last 5 years have changed in your life. So you got so much range these days.
Maybe everything's changed, but my hairstyle and my gender, probably.
Yeah, that's a good point. That might be what's like. Well, and your truck. How old's your truck?
No, I didn't have a truck 5 years ago.
You didn't have a truck back then?
I was driving a little Mazda sports car.
Oh Lord! Now that certainly got the upgrades, hasn't it?
Gosh, L.A. slime
you
ball.
You could put your Mazda in your truck bed now. Your truck's so big.
No. My truck is not that big, but it could. No. I could tow it easily. I could tow like 10 of them.
Yes.
What are we talking about? Oh, tax-free kids. That's what we're talking about.
How would we have done that if we had done it correctly back then?
Right. What I love is these guys with 3 letters after their name saying, well, the best thing you can do is set up an S corporation, I say, and that's how you pay your kids tax-free. Yes, I know you can do that, but that's not the way to do it. Why? In an S corporation, and right now I'm working on a course to teach everybody what's good and bad about S corporations, and we'll probably do a podcast on it too. S corporations, you're not a member. You're not a manager. You're not a shareholder. You're not a director. You're an employee owner. Now, yes, you're a shareholder technically, but you're an employee owner. Employee owners must get paid a wage. Reasonable, by the way. We're not going to get into that. It's a whole other conversation. So if you dump your kids into an S corporation, guess what? They're going to have to get paid with a W-2 and unemployment insurance and FUTA and all that other junk. There's FICA involved. So would they potentially be avoiding federal and state? Yes. And I'll show you how to do that. But you're still going to have to crank 15.3% towards them. Plus, why do it? Not worth it. Instead, The Augusta Rule is not quite the same. It's really clearly in the code. There is no part of the Internal Revenue Code that says you can pay your kids tax-free. That's not there. Sorry. Anybody who says it's right there in the code. No, it's nowhere in the code. I'm sorry. However, thankfully, there's a maxim in law that says, well, if A is in law and B is in law and C, the thing you want to do, doesn't contradict A and B or anything else, you can do C. So if A's clear, B's clear, and you want to do C, which kind of is something else but doesn't contradict A and B or anything else, you can do it. Now, some of you know what that is, and you put it in the chat if you know what that's called, the legal term for that. The Internal Revenue Code, the whole code is that way, which was what makes it so amazing. Some of y'all, I hate tax. Well, me too. We're not really supposed to have it as American citizens. We didn't have it until recently, but they've written it in a voluntary manner so that it is quite flexible. And this is one of those things. So what do we know that's in the code? If you don't make enough money to be as much as your standard deduction, 2025, that's $15,000, you don't file taxes. You don't owe tax. Cold, hard code. In fact, if you do, you could be subject to the frivolous filing penalty, the $6,702, $5,000. Gross. Don't do it. Another B would be if you have a partnership, not an S Corp or a C Corp, although you could sort of do this in the C Corp, but not an S Corp for sure. If you have a partnership that your parents own and your children are 17 years or less, or 22 years and less if they're a full-time employee, if they're a full-time student, then you can pay them as employees at any amount at all. It's not just $15,000. Any amount will do. And no W-2, no FICA, no insurance, none of that stuff. Okay, so that's A and B. You everybody with me? So what we can do is, and we do this all the time in Executive Money Strategists, this is kind of our business, is we say, all right, so therefore, if I have kids that I pay and I'm parents in a partnership, LLC, that pay them less than their standard deduction or up to $15,000 each, does that mean that the kids don't file that, thus making it tax-free to them, and I in the business get to pay them as an employee, but don't have to file FICA or any of that nonsense or W-2s and get to write it off? The answer is yes.
Oh.
But those are your parameters. That's it. You start deviating into other areas, it gets very, very dicey. Now, the question really is not, can you do this? Because of course you can. So easy. The real question is, all right, what would I do? Thank you, Sherry. What would I do with this money? Because these, for the most part, these are minors. And I don't mean like down in the coal mine. I mean like they're young kids. So yes, you could set up a custodial bank account for them and all that other stuff. But here's a mind-blowing thing that one of our members said. Could I pay my kid and then borrow the money from them and put it into like a family? I'm making this up. I'm not an insurance salesman, so don't think I'm trying to sell you insurance. I'm not. IUL, whole life policy. Could I set that up so that I'm putting money into that account from kid 1, kid 2, kid 3? It's tax-free. I get to write it off. And now only post-tax dollars go into IUL. Not no more. It's tax-free money going into an IUL or a whole life. And then after it matures and I continue to build this, can't I pull that money out and then use it for business or use it for kid stuff? And then when maybe and then the interest rates maybe between us and the kids 5%, which is less than what the IUL is paying. Couldn't you then, worst case scenario, pay them back with interest? When they're 21 or when they go off to college or when they get married, this huge lump sum. If they're 21 years old and you're paying them $15,000 a year, it goes up every year, by the way. What's the math on that? It's at least $400,000, $500,000. What a wedding gift. What a college gift. Maybe don't do it in college, but wedding gift. Or maybe you say, listen, I'm going to set you up with this life insurance policy. And now aren't you building the building blocks of the waterfall method that John D. Rockefeller has been coined with? And you're doing it outside of your business. Meanwhile, your business is still doing its profit and you're building generational wealth over here.
Yeah.
Guys, it's right there. And it's right there if we get a little creative. Is this illegal? No. But we can. And this is the power of what we love to talk about. Let's stack. Stacks over tax, y'all.
I love it. This is great, especially given how the cost of housing nowadays. Like, I would have really loved if I had done that for my daughter because, she's being a Texan. She is off living on her own little small farm and homesteading. And I really wish that I had been able to do something for her that was different because she doesn't really need a lot of money where she lives. And that would have made a massive difference in and just her quality of life and what she's able to do with her garden and animals and all those kind of things. Like, a little bit would have gone a really long way. So, yeah. Wonderful. Well, at the top of the hour, do you want to talk about health deductions and HSAs, or do you want to?
You know what? I think we should do another one. We'll kind of review this. The next one we do, and then we're going to bring up the HSA, the married filing separately situation, which some of you are already going, well, I have the business use of my home. I want to use the Augusta Rule. How do I do that? Well, I'll give you a little pre-knowledge, pre-warning, forewarning, whatever that is. Premonition. I don't know. And we also need to talk about 8829. So we basically talked about all the non-business deductions that you can do. And what we need to cut into now is the business side of the deductions that ain't nobody taking, like the 8829 form. Everybody should be filling out the 8829 form, unless you have a multi-member company, and then you got to be renting your home. It's so easy. I'll spell it out for you. We'll spell it out because, Sterling plays dumb, but she really does understand it all. So, and then we're going to talk about HSA, which I know is not really business, but it really could be if you wanted to use it that way. And the very special thing that I learned about how to literally get like a $200,000 payday 30 years from now, tax-free, even more. So with that, anything else that we want to lay on them? We've got a webinar
coming up on the 27th of March. We're going to have a webinar night, and we really do go through some really meaty topics and have you really understand how they work and how they can impact your business. And we also talk a little bit about what we do all day, because we love what we do all day. Unlike other people in our sort of sector, we actually specifically focus our energy on education and empowering you to know for yourself all the steps of incorporating, of taxes, of trusts, so that you're never again at the mercy of the CPAs or the attorneys or even the bookkeeper. So it's really fun, and we're going to share with you a little bit about how we do what we do, and some of our clients will come on and say hi and let you know why they spend the week with us. It's super fun. We have a great time. So let me know. It'll be the 27th of March, and it'll be 5 p.m. Pacific. So come and join us, and you can find the registration link out on our social media.
Yes, indeed. Yes, indeed. All right. Thank you, everybody. And we will see you very soon. And introduce yourself. If we don't know who you are, reach out. You can reach out here on YouTube or anywhere on social media. And we're looking forward to meeting you. And until then, be wealthy.